I'm really excited to get to announce our next presenters, two of them, Ben Golden of Golden Tax Relief and Ron Fossum with Tax Plan Wealth. Ben is a national speaker for tax planning and has helped clients receive over $40 million in BP funding. As a tax resolution specialist, he helps companies and individuals out of dire situations. He saved clients millions of dollars and helped companies and individuals become financially free from past problems with the IRS, as he helps his clients create forward momentum by helping them reduce future taxes. Ron Fossum specializes in insurance, investments, tax structuring, and planning services. He has been interviewed on Wall Street Today, as well as seen on ABC, CBS, NBC, Forbes, CNBC, and Fox. Currently, Ron serves as a fractional CFO for 5 separate companies, as well as running Tax Plan Wealth, with a focus on reducing a client's tax bill by 50% or more, legally, morally, and ethically. So, gentlemen, welcome, and I am really excited to see your presentation.
Well, thank you. We're looking forward to making taxes exciting.
If they can be. So today we're going to talk a little bit about coronavirus. What now? Planning in and after the pandemic. So today we're going to talk specifically in regards to the Family First Coronavirus Act, CARES Act, the Potential Heroes Act as an overview. We're going to look at some unintended consequences that we think that you should pay attention to, as well as what we call stacked planning and PPP forgiveness. Now, I do have to throw the disclaimer out there that this is an overview and it's not intended to give you all of the information with the COVID-19, coronavirus, CARES Act, credits, loans, information for you to write a research paper or anything like that. So without further ado, I think we should just break down the rules on what we know.
So there were multiple phases as this has been rolled out by the government. So the first phase was predominantly just for the testing of all the vaccines, and that's what created the economic injury disaster loan. So that was phase 1. That was done in March 6th of 2020 when that got implemented. And then not even a full week later, then we had the Families First Coronavirus Response Act. So that was phase 2. And we're going to talk a little bit about that one. There were some tax credits in there for some business owners and how to treat the time off that you got from your employer. And then phase 3, which is probably the one that's got the most press, was called the CARES Act. So again, about a week and a half later, March 27th is when that one was passed. And then they added some additional funding. So they ran out of funding in, what was it? It was less than 2 weeks for sure. I think it was more like 10 days. They completely blew through their funding. So they acted a month later and gave us some additional $2 trillion for that funding. And they're still working through that funding. And then what's currently going on in, we won't spend a whole lot of time on what they're arguing about in Washington, D.C. right now, but we'll touch on the HEROES Act, which is still to be determined, but what it looks like right now, as far as we know.
So I'm going to just jump in real quick in regards to the Family First Coronavirus Response Act. Now, some things that you want to understand is there are 3 credits that were available regarding the Family First Coronavirus Act, or the FFCRA. They specifically dealt with payroll and sick leave for 2 weeks, as well as family leave for another 10 weeks. And you can get credits in payroll for those, for the time that you paid your employees while they were sick or away from work, as well as some credits for paying for those employees' health insurance at the same time. The wages are considered income. However, the companies that pay those wages cannot deduct those expenses. Now, This can be used with the CARES Act PPP loan as well as the EIDL loan. So you can use it, but you just have to make sure you do not overlap those funds. There are some exceptions and some other rules do apply, but just make sure that you know all of the rules before you apply everything there. You know, included in the FFCRA is some additional coronavirus testing as well as funding for vaccines. They appropriated some money for the U.S. food programs like WIC and things of that nature. And then they extended some unemployment benefits to state funding. Now, the CARES Act was the next phase that they put into place. It introduced PPP loans, the EIDL loan grants, unemployment that went to $600 per week for federal purposes in addition to the state unemployment amounts. Not only did it help with the companies and corporations, but it also helped individuals. Now, a lot of people got a $1,200 stimulus per person. So if you're married filing jointly, that's $2,400 plus a $500 stimulus per child. A couple things that did not get a lot of press, but are definitely worth mentioning, the fact that retirement funds, you could draw money off of your retirement fund without an early penalty. So the 10% early withdrawal penalty was waived. And then if you took up to $100,000 out of your retirement, then you have up to 3 years to pay that back without having to pay taxes on it. Now, they also did help people with RMDs, and they did suspend those RMDs as well. With the Coronavirus Act, they also gave us some credits if you don't take the PPP loan. Now, you have the choice to take which is best for you, the PPP loan or something called the employee retention credit. Now, the employee retention credit in and of itself is definitely something that helps businesses that I guess you would say have the income, the employees could not apply for that loan or qualify for that loan, and it's $5,000 per employee. Now, I will tell you that one thing I want to show you is not only do we have the retention credit, but we also have the deferral of payroll taxes for 2 years. So that means that if I pay your payroll, if I pay you for payroll, I don't have to pay those taxes for 2 years roughly. Now, one thing that the TCJA or the Tax Credits Job Act did back in 2018 was it stopped some net operating losses. Now, the CARES Act let us take those net operating losses for 18, 19, and 20 only. And they also extended the statute of limitations for the refunds. In addition to the NOLs, they gave us some charitable contribution deductions, as well as redefined some corporate expenses and created a lending program called Main Street. And this is for what we would consider middle-sized businesses. Now, for me, I don't think they're middle-sized businesses because they have up to 15,000 employees. I don't understand how that is a middle-sized business, but it's large. As well as that, they also gave us some credit protection for forbearances and mortgages, as well as stopped evictions. And believe it, they gave the USPS $10 billion for a loan. And there again, these are things that not a lot of people know about. Now, phase 4, which is the HEROES Act, has already passed the House and it's waiting on the Senate. And we don't know how much Senate approval there is for it yet, but let's talk a little bit about what it does. So the CARES Act was 880 pages. Ron, did I tell you how many pages the HEROES Act is as it stands right now?
I thought it was in the neighborhood of like 1,800. Am I close?
Yeah, that's right. 1864, 1,800 pages. That's over 2 times larger than the CARES Act. And the CARES Act really turned our world in the tax and accounting world upside down, because there's just so many additional things that we have to look at. So not only is it 2 times more documentation or information in there, there's a lot of things that we think are hidden in there as well that we just hadn't been able to find yet. They do want to look at something called a business interruption credit for self-employed individuals. They want to change some things in the PPP and get it a little bit better, expand the Main Street lending program, as well as the unemployment benefits. And you know, Ron, this is one thing I didn't put on the slide, but the House put in that they wanted to change the voter ID requirements for states. So as you can see, there are some things that are in there that are a little surprising. One thing I did want to do, or we did want to do, was put a side-by-side comparison of each of the loans together and how they work together, both from the CARES Act and the FFCRA. So we can look to see how these do work interchangeably, right? So most of us already know about the PPP loan and the EIDL loan and a lot of the things that they're doing. For example, the EIDL loans that they said that they would give you $2 million to start off with. Well, they changed that to $150,000. One of the things that a lot of people have not done, Ron, you and I talked about, was how do each one of these items work with the PPP loan, because so many people have attempted to get the PPP loan and so many people have wanted to get the PPP loan. So how do they work interchangeably? And this is something that you may not have seen before, is with the PPP loan, you can use the Family First Coronavirus Act. You can use the EIDL loan. You cannot use the employee retention credit, and you cannot use the employee retention credit with the FFCRA unless some very specific rules match. You can defer you cannot defer your payroll taxes unless it was before the PPP loan, and then there again, both Main Street lending and there's additional relief programs.
So there's, of course, the way they rolled this out was Congress talked about it, Senate passed it, President Trump signed it, and then they announced it to the world. And then that's also when they told the SBA, that's also when they told the Treasury Department, and all of America found out like all at the same time. So there's been a lot of unintended consequences. And that's why some of these rule changes that Ben just went through have been complex, or, what passed as a bill then gets over to Treasury, and then they change it, and then gets over to SBA and they change it. And so they're finding out all these unintended consequences. So there's another one when it comes around to a forgiveness of a loan. So typically, if you're forgiven a loan, the IRS usually deems that as phantom income. So you go borrow $100,000, you default on the loan, the borrower says, or the lender says, don't worry about it. The IRS is going to treat that as income. So specifically in the CARES Act, when they wrote out these loans and they said this is going to be forgiven, they added a clause that said this is not going to be considered income, and it's going to when it is forgiven, and that's at the federal level. But as you look at the states, states have kind of chosen how they want to comply and align the state rules with the federal rules. And so there's 21 states that have called rolling conformity. And so they just kind of determined each state individually that says, we're just going to roll with whatever the federal government does. And so we'll just always stay up to date. They don't have to go back and do anything or change anything in order to be in full compliance with the state aligns with the federal government. There's 15 states that have what they call static conformity. So it just stays put until that state legislature goes in and updates it. And then there's 5 more states that do it on a very selective basis that starts to pick out pieces and parts, as if it's not complicated enough, to what they do want to align with on the federal government, what they don't. And some of these states are really far behind. And so as it stands right now, there's not a single state that aligns 100% with all of the IRS provisions without some tweaks or changes in there. So when you're filing your taxes this next year, there could be some that are in for a surprise. And so here's just a screenshot. I won't bore you with going through all 50 states for sure, but so it's the blue states is what's on the rolling conformity. So they're already going to align with the federal government. The yellow states are the static states. Those are the ones that are going to be that have to go in and change, and more than likely they haven't, because PPP and federal government forgiveness rule is so new. These states haven't aligned their state taxes with it yet. And then you notice California is static pre-Tax Cut and Jobs Act. So they haven't even caught up. Same with New Hampshire and, is that? Yeah, it's New Hampshire, the upper right-hand corner. So they haven't even aligned with Tax Cut and Jobs Act, which was passed in 17 and implemented in 18. So they are really far behind. And then you can look at this, you can see the gray states. Those are typically don't have any individual or corporate tax. And you may be looking at Florida and going, well, there's no state tax in Florida. And that's true on the individual side, but it's not true on the corporate income tax side. And this is all corporate loans with a personal guarantee. Most of them will have a personal guarantee. And so we could, depending on where you live, you could actually be in a position where you get the PPP loan, have it forgiven by the federal government, and then not have it forgiven by your state, and turn around and have to claim that as income or revenue on your business. And that's going to be a surprise to a lot of people. I have not seen or heard of a single webcast, podcast, anyone else really talking about this difference between states. And some of these are pretty, like the dates are pretty significantly different. So like California's last update was 2015. New York is a rolling. Florida is static based on this last update for corporate only. Maine was selective based on a 2005, but some of their other rules they've updated since then. So if you can imagine, this is 2020. They're 15 years out of alignment with what's on the federal tax roll.
So Ron, let me just interject one thing and let's talk about what this exactly means, because if you're in California, California has a maximum rate of 9.6%. That means that if I got a PPP loan from the federal government and all of it got forgiven on the federal side, then the state, what is the state going to do, Ron? It's going to make me pay taxes on that $100,000, right?
Yeah.
So when I go and look at my tax bill for the state of California for 2020, it's going to be inflated by roughly $9,600 or $10,000. And guess what? That's an unintended consequence that unless California makes that change, then that unintended consequence is going to make a drastic change in how much you're going to owe, right?
Absolutely. Absolutely.
So along with the unintended consequences, not only do we have the state in unintended consequences, but we also have some IRS unintended consequences. And what does that mean? I believe that future compliance is going to change dramatically. The reason is because when people went to go get the PPP loan, a lot of people were sort of found with their pants down because they did not have their payroll correctly instituted in their S corporations, or they did not understand what a guaranteed payment was in a multi-member LLC, or you know, both the single member LLC or a C corporation. You know, I think that because of all of the changes that everybody had to go through to see, can I get compliant with a PPP loan? Can I get a PPP loan? Because a lot of people went back and changed the way that they were taxed from a payroll side, I really think that the IRS is going to focus on that. Now, I talked to somebody the other day, and over 35% of the United States government's budget comes from payroll taxes right now. It's sort of surprising. 51% comes from income taxes from individuals. 35 comes from payroll taxes, and only 6% come from corporate income tax. So thought that that was the statistics there were a little. I thought that corporations paid more tax than that when you looked at the federal government's budget, but they didn't, and I was surprised at that. You know, Ron.
Absolutely. I think there's one more unintended consequence right there, that when you're looking at all these corporations or companies, there's a compliance component to that. And what we're seeing with all of the companies that are acting as registered agents is let's just face it, some companies are shutting down because they've already crossed that line. Like, a loan is not going to do them any good. And so you can't just like park your car on the side of the road and walk away from your company. There's very specific processes around how to shut down the company, or they're going to be able to pierce this company veil or the corporate veil and come after your personal assets. And so how to shut the company down properly is critical. You should be having some resolutions, some minutes and some amendments, and some letters to shareholders, all of those things, in addition to the IRS component, which is you have to notify the IRS of that this is the final return. Don't expect any more. And if you don't do that, they're going to expect more. Is that right?
Yeah, that's exactly right. I mean, if you don't close a business down properly, we both know and understand at the end of the day that you're going to create more problems than what you could imagine.
Yeah, for sure.
So there's another portion of this that we really haven't talked about. And if you have tax problems, let's talk about that a little bit, Ron, if you don't mind.
Absolutely. So it's one idea to have a plan, but when you've got multiple tax acts that have been passed over the last few years, what is most powerful is when you have not just one idea, like, oh, I'm going to write this, I'm going to claim this one deduction. But if you start stacking some of these laws together from multiple tax acts, it is an art, more than it necessarily is science or math. But understanding exactly which tax acts have brought together what benefits, and then if we can arrange them in a way that can stack, and they create something much more, as you see in the picture, much more beautiful, but also much more powerful when you see some of these results. So we're just going to walk through a little bit of what that might look like for you, and understand that the most powerful position to be in is in a proactive position throughout the whole year, implementing some of these different strategies, so that when you get to the end of the year, you're not in this reactive, what could I have done 6 months ago or implemented to reduce my tax? And that's really when you start seeing companies like Amazon or Netflix that, reported that they didn't have to pay any corporate taxes last year, even though they made billions. They didn't just wait to the end of the year like a lot of small business owners do. They're proactively working on this throughout the whole year, so that it's not a surprise. So it's a plan. In the industry, we always joke that there is no such thing as an end of the year tax plan. Like that's one of those oxymorons. Jumbo shrimp doesn't exist. So understanding not just individual strategies, but how they can all relate to one another. So how does a retirement plan affect it? How does children's education planning affect it? What's the real motivation for doing a tax plan? What would you do as a business owner with an extra $10, $20, $30,000 that you're overpaying the IRS? Would you hire that key employee? Would you do the marketing you should be doing, or now you need more marketing during these chaotic times? Like, how would you redeploy those dollars? It's not just identifying the dollars, but let's put some real thought into what's going to move the needle the most in your business to make sure that we hit these new goals and your business is around long term, for sure. So let's just walk through a real estate example. I think real estate is a tangible item. Everyone can kind of relate to it very easily. And I think most of us have heard the stat that there's more millionaires created out of the real estate space than most any other asset class. So in this case, we're just going to say that the owner wants to build a new home for his wife, wants to save some money for his children for their education, and he wants to invest into not just single family homes, but in this case, he wants a commercial property. So maybe it's a small strip mall, maybe it's multifamily homes, something along those lines. But that's what he's talked about wanting to do. And then we can start to look at a little bit of history here. So in the Chevron sign there, you see the year that the Tax Act was passed, and we're not going to go through these year by year, but back in 1931 and then 1932. So back 1931 gave us the step up in basis, and what that allowed us to do is when someone inherited a property, then that value was stepped up to its current market value instead of using the cost basis number. 1921, we had the 1031 exchange rule. I think most of us have heard about that, where you can exchange a like for like exchange. I'm going to sell this piece of property, buy another piece of property, and I can roll all my gains into that next property. Very similar to 1035 exchanges in like life insurance and annuities. I'm going to sell this, I'm going to close this policy, roll that cash into the next life insurance policy. So there's multiple ways that shows up in the tax code. 2014 gave us the tangible property regs, which is, it kind of broke apart when is something a repair and that needs to be expensed versus when is it an improvement, and that becomes something they call a capitalized item. And that's just something that you start to depreciate over time, versus a repair says it's an expense this year, I had to do it, and you're going to be able to write the whole thing off that year. 2017 gave us the Tax Cut and Jobs Act. That's the Trump tax plan, got implemented in 18. And in there, they gave us something called bonus depreciation. And bonus depreciation said anything that was taken out of the normal depreciation. So if it's a commercial property, it was depreciated over 39 years. If it was a single family resident or a rental or a smaller property, it was 27 and a half years and 39 years, right, Ben? Those are the two.
That's right.
So when it's pulled out of, then that's real property. So it gave us personal property as another category that goes along with real estate. So when it's pulled out of those categories, and now we've accelerated, like the carpet's not going to last 39 years, right? The flooring, the windows, the HVAC unit. So we pull those things out and we put a 5-year lifespan on it, a 7-year lifespan, maybe even a 15-year lifespan. We've accelerated that depreciation from 39 years all the way up to 15 years or for 7 years. So obviously that accelerates the depreciation, that increases your deduction and helps your property cash flow more. And so that's what Tax Cut and Jobs Act gives, was bonus depreciation. Once it's in that category, we can then bonus it all up to the first year. Just by putting it into a category, you've gone from 39 years to 5 years, 7 years, or 15 years, and then add bonus depreciation to 1 year, which is obviously a massive deduction in that year. So then we have 2020, we had the CARES Act, which then shows us that we lost this under the Tax Cut and Jobs Act, this 5-year net operating loss that Ben was talking about. That went away, and now it's back under the CARES Act. So now we can also combine this with a cost segregation. And so that's along when we're talking about that bonus depreciation, we're just going in, and this has been around since 97. We're just going in and identifying the different areas in the building that could be segregated and putting a new cost or a new lifespan attached to each of those individual assets. And we start to stack some of these together. We're going to walk through an example of what some of these numbers mean. But now that you start to understand, here's the different tax acts that all relate to this. So here it is in a visual. You can see the basis of the foundation, which is the strongest piece, which is really, you own a piece of property, we can do a cost segregation on it, roll that up to the CARES Act, roll that up to the Tax Cut and Jobs Act, the tangible property regs, all of that. And then we'll show you exactly what that looks like in some numbers here in just, so the next slide that we got some numbers. No, it's a couple more slides. We're gonna tease you. Or no, we took that numbers out, didn't we?
Yeah, we took the numbers out strictly because, everybody's a little bit different.
Yeah.
And, tax planning is about how you take multiple different strategies and use them sort of in concert together, I guess you would say. And the beauty is, like, for example, on this person, not only are we going to look at, items that are going to affect just the property, but we're going to look at other items that affect how the business shows profitability, how we can take legal deductions out of the business and push it into the person's pocket and things like that.
Yeah. Frequently, when you start accelerating the depreciation like that on properties, even though it cash flows and you made profit for the year on paper, frequently you don't show a profit, and then hence you don't pay a lot of tax on that. Here's some of the other things that we could consider for this same person is this home conference room idea, which is separate than having a home office. So it's called the Augusta rule because it comes out of Augusta, Georgia. The senator in Augusta in Georgia didn't want to pay taxes. He had a house on the golf course, and they have that Masters golf tournament there. So you're able to write off meetings in your own home or rent your own home out for 14 days a year to anyone in America. So think Airbnb. You could rent that out for tax-free income. But also, remember, if your business has an EIN, you personally have your Social Security number. You can, under the tax law, you're two separate entities. So you can rent your home personally to your business without violating self-rental rules under this Augusta rule. And again, that's separate from having an admin home office where you're really conducting day-to-day business. And it's an admin home office because your clients necessarily aren't meeting you there. Your administratable or accountable reimbursement plan, think of that more like a employee expense account. We've all heard of those. And so frequently, this is just the employees, even if it's a 1, 2 person, 3 person member company, just the employee, Ron, the employee asking Ron, the business owner, can I expense some of these things like mileage? Can I expense my home office? Can I expense this meal where I met with a client? And when that reimbursement comes back to you, reimbursement's not income, right, Ben?
That's right. No, it is not income because of the way that it's treated when it comes back to you. Mm-hmm.
So it's a way of pulling money out of the business in a completely tax-free environment that is very beneficial. And there's some very specific IRS rules to follow, and it's really simple. But if you just follow the rules, understand the game that we're playing and document properly, like these aren't super complicated, but we can start to stack some of these together.
And that's where the real savings comes into play. When you start doing 2, 3, 4, 5 of these things all at once, the small numbers add up to be definitely larger numbers. You don't have that one magic bullet, that one magic bean to build the beanstalk or the one magic bullet to stop all taxes. There's no such thing. But if you do a lot of small things, it's going to add up to a large number at the end of the day.
Absolutely. Absolutely. I mentioned cost seg already. The 1031 exchange I've mentioned already. There's something called installment sales, where if you sell a property, or actually you sell almost anything, and take payments over time, you only have, as you receive payments, then that's what you claim as income. You don't have to claim the entire sale right up front. So installment sales is a fantastic way. In the last quarter of the year, I tend to start promoting installment sales a lot in my companies, so that I'm just punting it literally into the next year, so I don't have to do that. There's also something called monetized installment sales. If you guys have ever heard of Kimberly Clark, that sold for 617 million. If you heard of Office Max, back when there was Office Max and Office Depot, Office Max sold using a monetized installment sale, and it was $1.47 billion. And they did so once they got a letter from the IRS that says, yes, we totally understand you're selling for 1.47 billion, and we're not going to get paid for 30 years. So it's a fantastic way to sell a business, or any kind of highly capitalized asset that has appreciated over time, and again, punt that ball down the road. Sometimes it makes sense to pay a little bit of tax as you go, but sometimes it totally makes sense to defer it. With the monetized installment sale, you have the time value of money on your side. Money tends to double every 7.2 or 10 years, depending on your rate of return. So you're going to pay that with depreciated dollars way in the future. And it can be part of your estate plan. You can partner it with a trust. You can partner with life insurance, all kinds of other stuff. We talked about the CARES Act and the net operating losses already. I've drawn a blank on the qualified improvement deduction. Help me with that one, Ben.
Yeah, so what happened was the TCJA took away some qualified improvement deductions and said, oh, you can't deduct this right now. So the CARES Act said, oh, yeah, you can deduct that right now. And just remember that every one of these are just 12 examples of what you could consider and what we could do. So it's not really about specifically the things to do. It's knowing that we have to use these things, like we said before, in concert together in order to get that beautiful orchestra sound. And that's the beauty of it. So not only are you going to take, these 12 strategies just as a consideration, but, if we look at the savings themselves, the savings are predicated on several different things. Do you have NOLs? Can we do a cost segregation? Did you purchase property in the past 5 to 7 years? Do you plan to sell some property to do that installment sale or the monetized sale? There's multiple things that you can do in multiple different ways, but Ron said it from the beginning when we started talking about stacking is you can only plan moving forward. Retroactive planning is not planning, that's hoping. And in the tax world, hoping doesn't really work that well. Right. So in addition to that, there's medical expense planning. There's multiple ways on how we can do it, but understand the savings there again is predicated on exactly what we do. And I don't know if you saw it, but in a prior slide, we said maybe that real estate investor does not want to do a retirement plan. So we don't add that in. But retirement planning could be a good way to save money in the future. There's multiple ways. I know Ron, how many plans how many strategies do you have now in your deck that you use?
We call it our ultimate tax plan is north of 170 strategies. It's knocking on 200.
So almost 200 strategies. Now, not every one is going to be for everybody, but I mean, you think about it, if you could take, 10% of those and put them into place, I mean, that would save you a lot of money when you talk about stacking. But being proactive in tax planning is not the only thing that we want to talk about today. Let's look back and focus on, we've been talking about coronavirus planning. What do we do in the future? Where's it going to take us? What do we do right now? Let's talk about the right now. Is that okay, Ron?
Yeah, absolutely. It's especially if so people are usually in three boats. They're either growing their company, they're thriving, and they don't need any help, which is great. Some companies are in crisis mode, and the loan borrowing money, going into debt with the hope that it's going to be forgiven, might make sense. And then some people have already crossed that threshold where they've just got to close down, and maybe you already have. But regardless of where you're at, this piece here is really for, does it make sense to have the loan or to go into debt, and you've gone down the PPP route? How can we make sure that the majority of that, if not all of that, can be forgiven? So why don't you walk us through that a little bit?
Yeah, so number one, they've made some changes recently in the past couple of weeks in regards to the forgiveness. And, one of the things that they did with the PPP loan itself is they named it this wonderful name. It's the interim final rules. There again, Ron was talking earlier about, things like jumbo shrimp, oxymoronic, words that these people use. It's an interim final rule, people. Don't you love it? But, number one, the first thing to think about is if you get your PPP loan, your PPP is not automatically forgiven. You have to do an application now. And along with that application, you have to put a copy of a lot of the information on what you should have forgiven as well. So the SBA changed their mind. The government actually changed their mind. Could you imagine that, Ron? That's never happened in the history of the world, has it?
Yeah, no.
So the SBA changed their mind and they said, look, we are not going to be responsible for figuring out how much the forgiveness should be. Hey, lender, you sent the money to them. We gave it to you, but you sent the money to them. Bank, you are responsible for taking the application and making sure the application is valid and to make sure all the items on the loan can be forgiven. And by the way, we're not going to give you very many different variations. This is the way that it should be. So, the lenders are sort of thrown out there to the wolves. The changing rules on the interim final, there's changing rules on the 75-25 rule. We haven't even gone over that, Ron. The FTE rules or the full-time equivalent rules. FTE employees came in under the Affordable Care Act of 2010, which was also known as Obamacare. They're looking at rules that are 10 years old, and they're saying, okay, we have to apply these rules now. Owners are looking around and saying, look, you just gave my employees an extra $600 a week to stay on unemployment. What happens if they're making more money now than what they were before and they don't come back to work? There are so many different things that the forgiveness item in itself, I look at it like this right here. If you're driving in a car and tax planning is sort of like the windshield. There's a reason why the windshield is so large and the rearview mirror is so small in an automobile, right? Your number one concern, your danger is in front of you. It's not behind you. I help with tax resolution, people that have tax problems. I work in the rearview mirror, okay? I protect your six. Ron focuses on, the plans, stacking plans, being able to save you money. He works on what's in front of you. But when you're driving down the road in your car, you have to look for potholes. You have to be able to dodge and move and make decisions in your business. And the potholes are what's going to knock your car out of alignment. It may not wreck you, but it's going to cause you problems. Interim final rules change, 75-25. Forgiveness, what do you do? There's so many things that people don't understand and don't know, when it comes to the Family First, the CARES Act, what's going to happen with the HEROES Act. What happens if this changes? And, you know, there are so many different things that people, now that they have their PPP loan, they have a lot of questions on how do I have it forgiven? What happens if I didn't set up on my own bank account, a separate bank account for the PPP loan? And can I still get it forgiven? Is it true that the SBA looks at first in, first out items, and if there was money taken out of your account and it's not a allowable forgivable expense, can it be forgiven? What do we do? How do I get someone to advocate on my behalf and be that person that's going to be the go-between between how much I need to have forgiven and how much I was given? And we haven't even mentioned, if you get an EIDL loan, that it's not going to be included in an allowable forgivable expense and things like that. So, you know, while we have not focused on the PPP and the forgiveness, it is part of what the next step is right now. And, you know, Ron, when we look out and we're driving that car, we have things that are close in front of us, and then we have things that are really, really far in front of us, you know, sort of like the planning could be something that we do a little bit further down the road, while the forgiveness is something that's on us right now. And we have to focus, do I need to shift or change or move the car in order to not hit that pothole?
Well, and when you think about it, there's so many changes. Like no one would go buy a piece of property and close on the property without the bank giving you all of the terms. But that's essentially what the government's forcing everyone who's done these PPP loans. Literally trillions of dollars have already been given in loans, and then they keep changing the rules, the terms after the fact. And that's just a high risk proposition and silly. And it's I'm in the business, and it's tough to keep up with them all. I can't imagine trying to run a separate business and trying to figure this out as I go.
So, you know, today I think that what we can do to help someone is you don't have to learn all of those rules. You don't have to learn everything that the government is changing, because, you know, believe it or not, it's probably going to change again. You know, the interim final rules, they're called interim final because guess what, Ron? They're not final. They're interim final, which means that interim final will ultimately change. So, you know, if we're going to focus on what's right in front of us at hand, do you want to tell them a little bit about the PPP forgiveness process that we've put in place and how we can help them make sure that the loan that they've got is something that can be forgiven?
Yeah, part of it is just trying to make sure that you have, just like every tax structure, tax credit, tax deduction, tax exemption is document. Just like real estate is all location. And so staying up to date on all these changes, it was as recent as today's the 27th. And it was last Thursday, they just changed the formula again for what is forgivable under the payroll side, right? So staying up to date on all these changes, we're going to give you a very detailed instructional video that explains step by step exactly how to go do it. We're also going to give you an Excel sheet to like plug in your numbers, and so you can see precisely how to go do it. And then if you get stuck, if there's any loose ends anywhere, just set an appointment with us. We'll jump on the phone with you and walk through any kind of loose ends, any questions you may have about how to apply this to your situation. Maybe the 8 weeks of your PPP loan doesn't align with the paydays that you necessarily have going on. How do you handle that on the front end? How do you handle it on the back end? You start splitting pay cycles, all those things. If you have any questions, just schedule an appointment. We'll jump on and answer those. So if you go to goldentaxrelief.com/SBA, goldentaxrelief.com SBA, there'll be a button. You can just click here and purchase for $147. We'll give you all of our tools, the most up-to-date information. If they continue to change again, we'll send you an update after that goes. goes out to you as well and keep you up to speed. And super simple. If you have questions from that same page right below the purchase button, there'll be an appointment link to our calendars, and you can just jump on the phone with us, ask us any questions you have. We'll be happy to jump on and answer those for you. So goldentaxrelief.com/SBA, $147. You see it on the slide. Simple step-by-step process to make sure that you're following the rules that are most up to date with the SBA.
Right, perfect. Thank you, gentlemen, so much for that. I was blown away by just the depth of that, and as you've said, it's going to be an interesting road ahead and probably hard to navigate. So anybody who wants to take advantage of your offer, just so you know, if you didn't catch it off of the slide, we do have it available on the link in the resource page. So you can go over there, catch the link, and get a hold of Ron and Ben and take advantage of that offer. So thank you so much, gentlemen, for putting that together. I found it really, really informative. Is there anything else that you'd like to cover before we let you go?
Oh, I hope everyone's doing well. These are some chaotic times. Everyone's business is certainly very different in the last 90 days, for sure. I hope everyone has got a very clear plan on a go-forward basis. Obviously, most business plans have changed and had to be modified, adopted, pivot, whatever you want to call it. If you need help with that, we can help with that as well. Like say, for Ben's business, what's the stat, Ben? 1 out of 50 Americans are behind in their taxes by 10 grand or more.
That's right. The IRS says that 1 of 50 either owes more than $10,000 to the IRS or has not filed their taxes in several years.
So if that's your boat that you're in, give Ben's office a call. I think he's got a screw loose. He likes to argue with the IRS. He's licensed to represent clients in front of the IRS. I'm not. I'm more about a planning guy on a go-forward basis. But he'll have your back on that side, and I can help on the tax planning side, the business planning side for sure. But we appreciate the invite. Hope there's lots of value in there for you guys.
Oh, I found it thoroughly educational, so I really did appreciate it. So whether our audience is looking through the windshield or if they're looking in the rear view mirror, we've got 2 incredible experts here with Ben and Ron who can take care of you. And I would strongly encourage you to reach out to them, regardless of whether or not you take advantage of that program. They are a wealth of information and we can get them to you. So go to the resource page, get their information, and thank you, gentlemen, so much for that wonderful presentation.
Thank you.
Absolutely. Thank you for having us.